All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hello, my name is Alex Mason. I am your host, and thank you so much for joining me. So we've gone through the three major financial statements: your balance sheet, your income statement, and your cash flow statement. Now I want to talk to you about some of the connections between these statements. And this is absolutely critical as you're recruiting for investment banking. This is one of those key areas of knowledge that will be required of you to demonstrate that you actually understand the basics of accounting. So definitely pay attention. Now that you have the building blocks of what those three statements are and some of the basic components within them, we now have a foundation to talk about how those things connect. So let's go ahead and talk about some of those connections now. Okay, so we have the three statements. We have your income statement, and then your cash flow statement, and then your balance sheet. So remember, our income statement helps us record the profit that a business makes. The cash flow statement helps us see the actual money flowing into and out of the accounts of the business over a given period of time. And then the balance sheet tells us what the company owns versus what they owe at a specific snapshot in time. So now let's talk about how these things are connected. So remember, first of all, in the corner here, I'm just going to write our basic accounting equation that we can't forget. Assets equals liabilities plus equity. Super important, and you'll see how this kind of comes into play as we go along. So let's talk about a specific scenario. Let's say that a business wants to buy some kitchen equipment for their restaurant. Let's say it's a restaurant business, and they're going to pay for this using cash. So remember that cash is an asset. So you have your assets, liabilities, down here. And so cash is an asset. So cash is going down in order to purchase this equipment. So what has to happen? If we're going to keep this equation true, assets equals liabilities plus equities, our assets just went down. So something on the other side of the equation has to change. Either our liabilities or our equity has to change. Now, the thing is, since we're buying equipment, we're actually getting something in return. We're getting the equipment which we can hold as inventory. And inventory is a type of current asset which goes on the balance sheet. So we now have our inventory going up. Very simple. So this is a very simple scenario in which your asset is going down, but another type of asset is going up. Your cash flow statement, remember, the cash is flowing out of the business because you need to actually buy the equipment. So cash is leaving the cash flow statement, is going down. Let's go ahead and do another example of how these things connect. Another basic connection that we want to look at in the three financial statements is how your profit relates to your equity. Remember, on the balance sheet, it's not just assets and liabilities. You actually have another piece here called equity or shareholders' equity. And so how does the equity connect to everything else? Well, if a business makes a profit, let's say they have some kind of revenue, there are some expenses. I'm just going to broadly put this as expenses. And then at the end, you have something called net income. Net income is the same thing as profit. So this net income, this profit, becomes part of the equity of the business. So this actually flows over here to your balance sheet and flows from net income into your equity. So your equity increases in a proportional way that your net income increases. So if a business makes $100 in 1 year, in terms of profit, that would flow into a $100 increase in your shareholders' equity. So that's another very important connection that we need to be aware of. Let's go ahead and look at something else now too. Okay, so let's talk about a scenario where a sale is made and the company makes that sale on credit. So revenue is going to go up, right? So revenue goes up because we just received some money, and the costs associated with that are going to go up because you require money to be paid out to, let's say, like material costs or whatever it is in order to actually make the product. So you have some cost of goods sold here. Now, when cost of goods sold increases, the inventory that the business had goes down by that same amount. So you can imagine if you have $100 of raw materials sitting in a factory somewhere, and that's getting converted into a product, your cost of goods sold now matches a proportional decrease in the inventory of that business. So inventory, which is an asset, goes down the same level that your cost of goods sold goes up. Now, at the same time, we said that the customer here didn't actually have any payment in cash yet. So even though revenue has gone up, we haven't actually received the money. So because of that, we have an asset on the company's books called accounts receivable. This is money that is owed to the company, but hasn't yet been paid to the company. So accounts receivable, abbreviate this AR. So accounts receivable goes up as a result of this sale. Okay, so now what happens once the company actually gets paid by their supplier? So cash comes in, so you would see cash flowing in from operations because you're getting paid now. And then what's happening now is your accounts receivable now goes down because you now actually got the cash. So you no longer have that accounts receivable on the asset side of your books. So that's what happens in a basic transaction where there's a sale on credit. You have accounts receivable and cash kind of interacting at different times. You have inventory interacting with your cost of goods sold. That's a balance sheet income statement connection based on the sale of the product. And so, yeah, those are some basic connections between the three statements in a very simple sale. Let's talk now about a similar scenario, but when a company needs to pay expenses as opposed to selling something. So we talked earlier about the fact that there are different types of expense categories. You have your cost of goods sold, your COGS, underneath your revenue, and then you also have your other operating expenses. So we'll just call them operating expenses. So let's say that you need to go pay some suppliers for some kind of like data or service, or you need to hire some employees or something like that. So your operating expenses go up. So you have some kind of cost here. Now, let's say that you're paying a vendor for something and you're doing it on credit. Well, cash doesn't leave the company right away. You are basically saying, hey, I'm going to pay you within a certain period of time. So as a result, your liabilities increase. This is called accounts payable. Accounts payable is basically like accounts receivable, except instead of being on the asset side of the balance sheet, it's on the liability side of the balance sheet. So accounts payable goes up. Now what happens is time passes and the company actually pays for the operating expense. So your cash is going to go down on the cash flow statement. That also affects your asset side of the balance sheet. Your cash is going to decrease. And in order for the balance sheet to balance, this accounts payable is now going to decrease as well, because now you don't owe that money anymore. It's being paid out. So that's what happens once the bill actually gets paid. So it's a link between the cash flow statement and then the balance sheet, and we have that own internal linkage within the balance sheet of cash going down, accounts payable going down as well in order for the balance sheet to balance. Okay, so those are some basic examples of how the cash flow statement, the balance sheet, and the income statement are all connected. Now, these were very simple, rudimentary, kind of like basic examples. We're going to get into some more specifics here in future episodes, but I just wanted to take several minutes to go through just very basics of what happens within each of these areas, because it's very important to understand. Now, there are other interactions here that I haven't covered, but we will cover those in time. All right, that's what I got for you today. Here on Investment Banking Insights, I'm Alex Mason, and I'll see you on the next one. Take care.